be in the following month. Also, information that they've given you about this budget is current assets as of June 1st. That's the beginning period that we're going to be working on. Include cash of $42,000, marketable securities of $25,000. Now, you may not be real familiar with the marketable securities term. So I'm going to tell you that those are types of stocks that you've bought in other companies for $25,000. Now, depending on the type of stocks that you buy will depend on whether you're going to hold them for a long period of time or you might want to sell them quickly. Usually marketable securities you're going to sell on a quick basis, so within the year. They also had some accounts receivable of $198,000. And this balance of $198,000 was made up of $150,000 that came from May sales and $48,000 that came from April sales. Sales on account in April and May were $120,000 and $150,000 respectively. Current liabilities as of June 1st include $13,000 of accounts payable that's incurred in May for the manufacturing cost. All selling and administrative expenses are paid in cash in the period in which they are incurred, and an estimated income tax payment of $24,000 will be made in July. We're doing a cash budget for Mercury Shoes, which is incorporated, which means it's a corporation, and corporations pay income taxes just as if they were people. So the income tax payment that they're going to make is going to come in the month of July. So that would affect July's cash budget. Mercury Shoes has regular quarterly dividend of $15,000. Now, because this is a corporate form of business, we pay dividends to our stockholders, and they're going to pay a regular quarterly dividend of $15,000 that they actually declare in July. That's when it becomes a liability, but it's actually paid or going to affect our cash in August. So this dividend of $15,000 will be coming out of the August cash budget. And then they tell you that management wants to maintain a minimum cash budget of $40,000. And what that means is they don't want to spend any more cash. They want to keep a balance of $40,000 in their cash account at all times. And so we're going to prepare a budget for June, July, and August. When we're preparing a cash budget, it's broken down into two main parts. One of the main parts is to determine the estimated cash receipts for that budget time period. And since we're preparing the budget for 3 months, we're going to be preparing the budget for June, July, and August. That's the time period. So the cash budget begins with cash receipts. Our cash receipts are going to come from our cash sales, and they're also going to come from accounts receivable that we're going to be collecting. Now, what I've done is I've prepared a cash budget for you, and in bold, I have what you would be answering in Cengage. There's a lot of additional information that I put into this particular budget to help explain where we get numbers. But the things in bold are what you're going to be entering into Cengage. And so the first thing that we need to look at is our cash sales. And you'll remember from your instructions that the cash sales were 10% of each month's sales. Right here in our instructions, they told us that they are expecting to sell about 10% of the merchandise for cash. So what we're going to do is we're going to take the amount of the sales that were given to us for June, and we're going to multiply that by 10%. And that will give us cash sales for June of 16,000. For July, it's 10% of the total sales is cash sales. So for July, our sales was 185,000. To find the cash sales, we have to multiply that by 10%. And that will give us the amount of 18,500. For August, we're going to take our total sales for August, which were 200,000, and we're going to multiply that by 10. And that will give you 20,000 as the amount of cash sales that we are expecting for the months of June, July, and August. The next part that we're going to look at, notice I don't have it in bold because there's a whole lot of explanation I've got to do before we actually figure out the amounts here. So we're going to start with what we're doing is we're collecting accounts receivable. Remember, this is a cash budget. It's all about cash that we're going to be collecting. And from our instructions, they told us that 60% are going to be collected in the month following the sale. That's after the sale. The month following the sale is 60%. And the remaining 40% is going to be collected the second month after the sale. So if you're doing a budget for June, we've got to go back to April to determine what the sales on account are going to be. The April sales on account are 120,000. That was given in the information for your problem. What you're going to have to realize is that 60% of the sales on account, which were 120,000, will be collected in the month following the sale on account. So it'll be collected in the month of May. In this problem, we're not doing the month of May, but I think you need to see this in order to see the pattern that is happening with our collection of accounts receivable. So we had to go all the way back to April to determine what we would collect in May. 60% are collected in the month following the sale, which would be May. Because we're not working with May, we didn't write any of this information down. But what we do have to write down is that 40% of the sales on account in April will be collected in June. So we're interested in June's budget. So this 120,000 of sales on account in April, 40% will be collected in June. So 120,000 times 40% is 48,000. We're going to collect 48,000 of the April sales in June. We need to look at the sales on account for May, which was 150,000 that was given in your problem. And 60% of the sales on account in May are going to be collected in June. So this 150,000 is going to be multiplied by 60% to give you 90,000 that we are expecting to collect in June of May sales. The other 40% of the sales on account for May will be collected in July. So 150,000 times 40% is 60,000 that we are collecting in the month of July from May sales. You have to determine the sales on account in June. In other words, they were not given to you. And to determine this, we will take 160,000, which are all the total sales. We'll have to back out the part that is cash sales. Remember that cash sales were 10%. So what I'm saying to you is to find the sales on account in June, we have to multiply 160,000 times 90%. These are the sales on account in June. And then 60% of the sales on account in June are going to be collected in the month of July. So 150,000 times 40% is 60,000, which will be collected in the month of July. These are May sales that will be collected in July. Sales on account in July have to be determined. The total sales was 185,000 that was given. 10% of those were cash sales, so the remaining 90% are sales on account. So 185,000 times 90% is 166,500, which are your sales on account in July. 60% of the sales on account in July will be collected in August. So 166,500 times 60% will give you 99,900 that will be collected in August. The remaining 40% will be collected in September. We are not doing a cash budget for September, so that's not applicable to this problem. What Cengage wanted you to record was the collection of accounts receivable for the month of June, and that's made up of 48,000 plus 90,000. So remember, in bold, I have the information that Cengage wants you to record. This 138,000 is made up of these two items. The collection of accounts receivable for July is made up of these two items. So we'll add them together to get 146,400. The collection of accounts receivable for August is made up of these two items. So you add these together to get 157,500. Once we know our collection of accounts receivable and our cash sales, the two amounts will be added together to get the total cash receipts that are expected for the months of June, July, and August. This 154,000 is 16,000 that we collect from cash sales plus 138,000 that is collected from accounts receivable. For the month of July, 164,900 is from cash sales of $18,500 plus what you collected on account. So $18,500 plus $146,400 will give you $164,900. For August, our cash sales was $20,000. Our sales on account, or our collection of accounts receivable, I should say, is $157,500. The two of these together is your total cash receipts that you've collected for the month of August. So the first part of the cash budget is determining your total cash receipts. The second part of the cash budget is determining what you are estimating that you're going to be paying out in cash, your estimated cash payments. And they're going to come from all of the items that you're expecting that you're going to pay cash for during the month of June, July, and August. So some of the cash payments are going to come from your manufacturing cost. Your manufacturing costs are going to include depreciation, insurance, and property tax expense, which represents $12,000 of the estimated monthly manufacturing cost. And I said a minute ago that it is included, but actually we're excluding the depreciation, the insurance, and the property tax expense because depreciation requires no cash outflow. We don't pay cash for depreciation. It's excluded from the manufacturing cost. Insurance we're going to pay in February, which doesn't have anything to do with June, July, or August cash payments. Property taxes are going to be paid in November, which has nothing to do with June, July, and August payments. So the first thing we have to do is back out $12,000 from our manufacturing cost. The remainder of those manufacturing costs are going to be 80% that are going to be paid in the month in which the manufacturing costs were incurred. And the remaining 20%, the balance, will be paid in the following month. So again, the items that I've got here that are not in bold are just showing you how we're going to come up with the calculations that I'm going to show you that are in bold. We're going to start with the remainder of May's manufacturing cost that would be paid in June, because the manufacturing cost are going to be paid as 80% in the month that they're incurred and 20% in the following month. For the month of May, in June, the remaining cost of May's manufacturing cost are going to be paid in June. This amount is going to be equal to the accounts payable balance as of June 1st. The amount was $13,000 that they gave you in the information to your problem. So the accounts payable balance, this $13,000, is coming from the given information. The $13,000 accounts payable was incurred in May. So all 13,000 of that has to be paid in June. The remaining 20% has to be paid in June. Manufacturing costs that were actually incurred in June were given to you. The amount that was given was $66,000 all total. What you have to do is subtract out the manufacturing costs for depreciation, insurance, and property tax expense because they don't belong in the months of June, July, or August. So we take 66,000, which was the given manufacturing cost for June. We're going to back out $12,000 of the manufacturing costs that were not paid in this month. And then we're going to multiply that remainder by 80% because they told you in their instructions that 80% of the manufacturing costs are expected to be paid in the month they are incurred. So 66,000 was the total manufacturing cost incurred, minus 12,000 that doesn't have anything to do with cash that we're going to be paying during the months of June, July, and August. Then we'll multiply that by 80%, and that will give you 43,200 that we are going to be paying of manufacturing costs that were incurred in June, and we're going to show it in June's figures. See, June's figures continue on down here. So this is for the month of June here. Manufacturing costs that were incurred in June, less the manufacturing cost of depreciation, insurance, and property tax, times 20% will be the amount that you pay in July. So 66,000 less 12,000 times 20% will give you 10,800 that are the manufacturing costs that we actually incurred in June, but will be paid in July. There's a pattern here, class. So you can see that I've kind of repeated myself here in line 46. Manufacturing costs that would be incurred in July, less the manufacturing cost of depreciation, insurance, and property tax expense. Those costs were not cash payments, would be multiplied by 80%, and that will give you the amount to be paid in July. In other words, 82,000, which was the manufacturing cost in July that was given, minus 12,000 of the costs that are non-cash related, times 80% will give you the amount of cash that you're paying for manufacturing cost in the month of July. In the month of August, our manufacturing costs that we incurred in July, less the manufacturing cost of depreciation, insurance, and property tax that don't require a cash outflow in this month, times 20% will be the amount that we pay in August. In other words, 82,000 less 12,000 times 20% is what we're going to pay in cash of the manufacturing expenses that we actually incurred in July. Manufacturing cost incurred in August, less the manufacturing cost of depreciation, insurance, and property tax expense, times 80% will be the amount paid in August. So 105,000 minus 12,000 that were non-cash related expenses for this month gives you the net amount of the manufacturing cost times 80%. So what you're expecting to pay off during this period of time is 74,400. Then I have totaled up my manufacturing costs for each month. Notice this is in bold, so this is what goes in Cengage. 56,200 would be entered in Cengage. It's made up of 13,000 and 43,200 combined. Add these two together to get this amount. Add these two together to get this amount. Add these two together to get this amount. Those are your total manufacturing costs that you're going to be paying for during the months of June, July, and August. Our selling expenses and administrative expenses, notice I have those in bold. They are exactly the same expenses that they've recorded up here in your information to your problem. And you might look at this additional information here. It's going to tell you about selling. Here it is right here. Selling and administrative expenses are paid in cash in the period in which they're incurred. So we don't have to multiply by anything like we did earlier. We just pick up the amounts and put them in for the selling and administrative expenses. So these are given amounts from above. We had one capital expenditure that we were going to make. A capital expenditure is one anticipated cash payment that we're going to be making for something special that we know that we're going to have to lay out some cash for. And I'm trying to see where they gave you that amount. Right here it is. Capital expenditures are going to come out of the August budget. So 120,000 is what we're recording here. We just brought that down. And then we have some cash expenditures for other purposes. One of those is income tax. Corporations have to pay income tax. So they're going to pay income tax in the month of July. This amount was given to you in the additional information. Since this company is a corporation, they're also going to be declaring and paying dividends. They're going to be paying the dividends in the month of August. So that too was given. And then you're going to add up your total cash payments, which would be for your manufacturing cost, your selling and administrative expenses, your capital expenditures if you had any, income tax if you had any. All of these are combined. So in other words, these two amounts in bold are combined together. These three are combined together. And these four are combined together to get your total cash payments. The next step is to find a cash increase or decrease. So what we would do in this situation here is we would look at the total of our receipts and we would subtract from the total of our payments. And what's left over is the cash increase or decrease for the time period, which is 57,800 in this case. So again, we took the cash receipts and combined them with the total cash payments. In other words, you subtract your cash payments from your receipts, and that will give you 57,800. For your month of July, the cash was an increase of 28,100. That's because when we combined our cash receipts with our cash payments, we had some left over. For the month of August, we had more cash that we were laying out than what we received in. And so we're at a negative amount or a decrease in our cash at 96,900. The next step is to put in the cash balance at the beginning of the month. Listen closely here. This 42,000 cash balance at the beginning of the month of June was given in the problem. That 42,000 comes from this information right here. The June 1st cash balance was 42,000. So they only gave us the June 1st cash balance. It's going to be our responsibility to figure out what the July 1st cash balance is going to be. So listen closely here. The cash balance at the end of the month is going to be your cash balance at the beginning of the month plus your increase in cash for the month of June. We're in June's columns here, so we're trying to find the ending balance for June. We had an increase in cash that we are expecting in the month of June of 57,800. We're going to add to that our beginning cash balance, and that will give us our ending cash balance. Our ending cash balance for the month of June will become the beginning cash balance for July. So the beginning cash balance for July came from the ending cash balance of June. These two are the same. The ending cash balance becomes the beginning cash balance for July. July's beginning cash balance plus the cash increase for July gives you total cash ending balance at 127,900. In other words, 28,100, the increase in cash for this month of July, plus the beginning cash balance gives you your ending cash balance. Your ending cash balance for July becomes the beginning cash balance for August. The beginning cash balance for August was 127,900. That came from July's ending balance. August had a decrease in cash for the month that they were expecting. When you combine that with the beginning cash balance, you still have some cash to operate with, but it's only 31,000 at the end of this period. Now you remember that we said that management wanted us to hang on to a minimum cash balance. That minimum cash balance is 40,000 that they want each month. This was a given amount. So for the month of June, we have to maintain 40,000 in our cash account. The difference between our ending balance in our cash account and the minimum balance that we have to maintain is an excess of cash. So what this means is we would have some cash left over that we could invest in something else temporarily. We have an excess of cash because management just wanted to have 40,000 on hand at all times. For the month of July, management still wants us to have 40,000 on hand at all times. But our ending balance in July said that we had 127,900. If you subtract the minimum balance from the ending balance, the excess of cash is 87,900 in July. In August, we did not have enough minimum cash balance available. So we ended up with a deficiency of our cash. So this $9,000 negative amount means that you're not going to have enough of the minimum balance to maintain it. So we might need to try to find out where we can get $9,000. And we could go out and borrow that money, or we could sell off some of our investments. Now, something I wanted to note in this problem in Cengage, if there's a decrease or deficiency, you have to enter it as a minus in Cengage or it'll count it wrong. So enter it as a minus in Cengage so it'll know that these things are negative amounts. In part 2 of this problem, the budget indicated that the minimum cash balance will not be maintained in August. Remember, we wanted 40,000, but we only had 31,000. This situation could be corrected by going out and borrowing some more money or selling off some of our investments, such as our marketable securities. That is, if the marketable securities are held as temporary investments to be sold off. At the end of June and July, the cash balance was more than 40,000, so we didn't have to worry about borrowing money or selling off any of our investments. But because we had that really large capital expenditure that we made in the month of August, it kind of threw us in the red here. So that's all that I want to talk to you about today. Remember, in Cengage, you're going to put in the amounts that are in bold. These other things, I just had to explain to you how we get to those amounts. And so we'll see you the next time. I'm going to stop sharing this with you now, and we'll see you later. Bye-bye.